Hi, and welcome to Hedge Fund Investor. I'm Karl-Mikael Siding. Today I'll talk about technical analysis. What is it? Does it work? When does it work? To what extent does it work? And what are the things that you absolutely should not rely on? So, the absolutely most important thing about technical analysis, it's really that it doesn't work. There is no magic called technical analysis that enables you to make good trades. These are just lines in a chart. The lines in the chart and the patterns that we see, they trigger a human drive to find patterns even if there aren't any real patterns. So this is the most important thing you need to remember about technical analysis. Don't rely on it except for just slightly better timing, slightly better prices in your execution of trades, investments that you have already decided on based on fundamentals. And second, which is why we talk about technical analysis at all, is that sure, there are tendencies, there are weak tendencies, there are trends and patterns that actually do work. They are there because the market is a market. It's like a town square market where buyers and sellers are battling it out in order to make this magic of price discovery. They are more or less eager to get their hands on a stock or to get out of the stock. They are driven by fear and FOMO. They are driven by greed, and they are driven by the willingness to make money, but also the fear of losing money or the fear of losing out of a good trade. Some people say that the worst thing that can ever happen to you is if your neighbor becomes rich. That is something that nobody wants to see. So I'm not really sure if I buy into that idea, and you shouldn't either, but that's the thing people say. Another is that there is no right price. So here we have the buyers and sellers battling it out, trying to come to the right price. The right price is the price for an asset that gets you a decent return and that compensates you for the time and the risk, the uncertainty in the investment. The problem here is that we know neither what the actual return will be in the end, nor the risk level. We can make estimates of this. We can make guesses as to what returns we will get. And we can make a kind of an estimate of how uncertain or certain that return will be. But we don't actually know for sure. That's why we have a market. And again, the market, these buyers and sellers, they are more or less sophisticated. They are more or less made up of robots and like software automated agents, and in some instances, very few actually of actual people making real decisions. And in this battle, in this very uncoordinated battle for finding the right price in order to get the right returns for a certain level of risk, we have two ways of conducting oneself. One is technical analysis, where if taken to its absolute most stupid extreme, is completely valuation agnostic. It only takes price patterns and trends into account. And at the other end, we have fundamental analysis, actual valuation of the underlying companies. And I think these two methods must be combined in order to make the best trades possible. But most people adhere to one or the other. So why does technical analysis work at all? Well, the reason is that price trends, once you have a price trend in a share, this will attract other buyers, thus prolonging the trend. This is the basis for all technical analysis. it's about trends and continuation of trends. And everything on top of that is just nuance and detail. We will get to that. Within a trend, there will be temporary profit taking. People thinking that we have gotten enough on this trade. There may be value-based investors that think that this is becoming expensive, so they are selling out. And then the trend continues and gets back to previous levels. So we have trends and we have short-term setbacks before going back to the trend. Other things we look at is previous peaks and bottoms, and various ideas for how to use these patterns and peaks and bottoms and trends and counter trends. In this, we will have various rules, for example, for when should you have the urgency to just hit the offer, buy from the offer, perhaps several levels up into the offer, because you are really that eager, you have found something that is that cheap, and the technical analysis is pointing towards an increasing price and a strong trend being established. Then sometimes you really should just go out there and get the shares as soon as possible, not least to minimize your future regret. And some other times, most of the times, you should just hide deep below in the bid, waiting for somebody, a more eager seller, to find you further down. Somebody who's as eager to sell as you were eager to buy in the previous example. And when to do which is what technical analysis can show you. It shows you when you really should be in a rush to buy and when you can definitely just wait it out in order to get a really, really good price. So, moving on to an actual example. This is Tesla's stock price, and I've entered into it a couple of resistance lines, support lines which support the stock price, and also this shaded area which is called a Bollinger Band. The Bollinger Band just shows when the stock price has moved away a certain statistical amount away from its average, and typically within a trend, the Bollinger Band might show when it's about time for a short-term correction, a short-term counter trend. So this is Tesla stock price for about 2 years. Going further and extending it to 5 years, we suddenly see a different pattern. I've used the same support lines in here early in the latter part, but also added a couple of other ones. The important message here is that, again, these are just lines in a chart. You can't really rely on them. They are interesting in themselves. Sometimes they can show you longer-term trends, but sometimes the really important thing here is when the trend breaks.